Welcome to Economic Insights, the podcast where we break down what's actually happening in global markets. I'm your host, Alex, and joining me again is Selim, a market veteran who's been navigating these waters for many years and now also produces our show. Selim, welcome back. It's been quite a week.
Thanks, Alex. Quite is putting it mildly. But let's be honest, the story of the week was the Fed meeting. Everything else flows from that FOMC decision and what Powell said after it.
That's exactly where I want to start. The Fed is the headline story.
It has to be. The committee is splitting apart at the seams, and that's reshaping expectations for the entire trajectory of monetary policy.
Walk me through what happened Wednesday. The Fed cut 25 basis points, but something was clearly off.
Something was very off. The committee voted to lower rates to 3.75 to 4%, which is what markets expected. But the vote itself told a story. You had two dissents. The Kansas City Fed President Schmid wanted to hold rates steady, no cut at all. Then you had Governor Moran on the other side wanting a 50 basis point cut. So you've got one governor saying we shouldn't ease at all, and another saying we should ease twice as much. That's polarization.
Those are serious divisions.
Exactly. And Powell's press conference made it worse, or clearer, depending on how you look at it. He came out and essentially said a December cut is not a foregone conclusion. He used the phrase not on a preset course. He spent time relaying the views of the hawks, what they think, people worried that we're easing into a stimulative stance when the labor market is still solid.
So even though they cut, the message was hawkish?
Completely hawkish. He reframed the cuts we've already had as risk management moves, not the beginning of a pre-planned easing cycle. That's a significant shift in language. The market initially expected maybe 3 more cuts through year end. That was never realistic. But Powell made it crystal clear. We're done for now, probably.
And the committee dissent summary mentions that some hawks are concerned about easing into an inappropriately stimulative stance. What's that about?
The labor market is still resilient. Unemployment is low. There's uncertainty because of the government data shutdown affecting job reports. Some committee members are saying, why are we cutting into this? If you're worried about inflation receding, okay, fine. But if the labor market is strong, you're potentially over-easing. That's the hawk position. In fact, on Friday, Laurie Logan of Dallas Fed and Beth Hammack of Cleveland Fed said they would have preferred no cuts. They are not voting members this year, but will be next. Along with Schmid, those are 3 powerful career Fed presidents with full credibility. Opposing them, Moran. Well, he is credible in his way, I guess.
We will leave the judgment to our audience. What was the equity market reaction?
Sharp rally early in the week on trade optimism. S&P and Nasdaq hit fresh highs. Big tech led. Small caps lagged. But that rally started to stall midweek when Powell delivered the hawkish message. Yields shot higher. The bear flattening was sharp. Markets went from pricing in rate cuts to realizing the Fed might be done easing.
And Powell also announced the end of quantitative tightening?
Yes, effective December 1st. They're going to reinvest agency securities into treasury bills to shorten the duration of the Fed's balance sheet. That's dovish on the balance sheet side. But again, it gets lost in the hawkish messaging. The net effect: rates are lower, but future easing is in serious question.
So we're now in this weird zone where the Fed is cutting rates, but saying they might stop?
Welcome to late 2025. The hawks on the committee apparently had more sway than markets realized, and Powell seems to be giving them airtime, talking about their views, their concerns. It's a split committee, and that's going to make predicting the next move very difficult.
Before we move on, were there other things happening that week? I know Argentina had big election results.
Argentina did, and the Merval rallied about 35% for the week. Political risk premium collapsed, structural reform probability spiked. That's significant, but from a global markets perspective, that's a secondary story. The Fed dominates the headlines because everyone globally cares about the Fed's path. When Powell pivots more hawkish, that echoes through everything: currencies, yields, EM valuations, all of it.
Okay, so the Fed is split and more hawkish than expected. How is that playing out across other developed markets? Europe?
The ECB held at 2% and didn't budge. They maintained their message that there's a high bar to restart easing. They actually shifted the language ever so slightly more hawkish, downplaying weak data and emphasizing that risks have become more balanced. But here's the thing, the ECB is not as polarized. There's more consensus that they're holding. The risk for the euro is that the Fed's hawkishness pushes the dollar higher relative to the euro, even if the ECB is on pause.
And the Bank of England?
The BOE is expected to hold at their next meeting. Similar story to the ECB, on pause. But there's debate about whether a December cut is possible if data keeps surprising to the downside. So, this week will be interesting. The base case is early 2026 for the first cut, but the BOE has a different problem than the Fed: weak growth and inflation coming down. Powell's got a strong labor market. The BOE is dealing with wage concerns and fiscal tightening from the budget. So even though the BOE is on hold like the others, the tone is less hawkish.
What about the Bank of Japan?
The BOJ kept rates at 0.5%, marginally dovish tone. But Ueda, the governor, raised the bar for future hikes. He's now waiting for spring wage negotiations to see early indicators before considering another move. So the next hike is probably January, though if the yen sells off too much, they might move sooner. The dynamics are different at the BOJ. They're dealing with a weak yen driven by carry trades and Japanese retail buying equities. That's a different headwind than what the Fed faces.
So we've got the Fed hawkish, the ECB on pause, the BOE on pause, the BOJ on pause, but facing currency pressure. Is anyone actually cutting now?
Canada cut 25 basis points and signaled a pause ahead, basically saying rates are now about the right level. But that's it. Chile held. Australia held because their CPI is too hot and broad-based. Central banks globally are essentially saying, we're done easing. That's a story. 3 months ago, everyone thought there'd be a cutting cycle through 2026. Now the view is more hawkish, more paused, more we've cut enough. That's an echo of Fed's messaging.
And that's putting pressure on other currencies?
Absolutely. The dollar is strong because the Fed is less dovish than expected. Sterling is weak because people are pricing deeper Bank of England cuts, and there's fiscal pressure from the upcoming budget. The yen is weak because the BOJ isn't hiking, and Japanese investors are selling yen to buy equities. The dynamics are all connected to central bank policy divergence. The Fed is the anchor, and everything else is pricing relative to that.
Let's talk currency moves specifically. The dollar's been strong, the yen's been weak. What's driving that?
Dollar strength is the Fed story. Powell's hawkish surprise, the no preset course rhetoric, the October cut starting to look like it might be the end of a cutting cycle. That supports the dollar. The yen is weak because the BOJ is on hold, and investors are engaged in this Takaichi trade, simultaneous selling of yen and buying Japanese equities. Dollar yen is testing 153. If it breaches 155, expect the Japanese authorities to intervene. They've been pretty vocal about that ceiling.
Sterling took a hit too?
Yes, the market is pricing earlier and deeper Bank of England cuts than the BOE is signaling. You've also got fiscal pressure. The UK budget November 26th is expected to be restrictive, and the OBR downgraded productivity. So you've got both monetary and fiscal tightening expectations. Sterling suffered.
The euro?
The euro's in a tough spot. Local data has been decent. PMIs came in above expectations, but the euro is suffering from spillover weakness in the pound and yen. Fed strength is also a headwind. We're probably drifting toward below 1.15 on euro dollar, but I wouldn't expect a collapse. The Chinese yuan, by contrast, should strengthen gradually towards 7.00 by year end because the trade tensions are easing.
Oil had a big move on Russian sanctions.
Brent surged nearly 7% to $66 a barrel on supply disruption fears from new US sanctions on Russian producers. Short covering rally. But here's the reality: any physical export disruption adjusts within a quarter as trade flows recalibrate. It's not a lasting shock. Oil is probably peaked locally.
And gold? That was a sharp move at the start of the week, followed by a recovery later.
Gold pulled back, but the bullish case seems to be intact. You're seeing massive open interest across commodities, base metals, energy, soft commodities. Capital is flowing to hard assets broadly. The gold dip looks to be a consolidation, not a fundamental break.
Let's hit emerging markets. Argentina was obviously huge, but beyond that,
Argentina was transformational. The ruling coalition won decisively in midterm elections, which means they now have the political capital to pass structural reforms, tax reform, labor reform, privatization. The political risk premium just evaporated. The Merval rallied 35% for the week. Bond yields fell sharply. Real yields dropped below 10%. We're talking about market reaccess via Eurobonds in 2026. That's a major repricing of the country's trajectory.
and the rest of EM?
South Africa's CPI inflation came in at a benign 3.4% year on year earlier in the month. With the better than expected PPI this week, inflation picture gives the SARB room to cut. Consensus expects a 25 basis point cut in November. Czech Republic is a bull case. Q3 GDP surprised to the upside, growth forecasts are up, and the koruna is well positioned if German growth picks up. Poland's CPI was 2.8% year on year, so the NBP will probably cut 25 basis points in November, but there are fiscal risks building. China is firmer on trade deal optimism. Overall, EM is better supported by the de escalation in US China tensions, but the Fed's hawkishness is still a headwind. You can't fully ignore that.
Next week is packed. What's the key event?
Bank of England Thursday is a major one. It's probably a hold, but the market is going to dissect the vote split hard. People want to know if December is on the table. That's a must watch.
US data? Do we get any?
October ISM manufacturing on Monday, services on Wednesday. Wednesday also has the ADP employment survey for private jobs. Critical, because the government shutdown has delayed official payroll data. If ADP shows stabilization or weakness, it's going to shape the "does the labor market justify more cuts?" narrative. Friday brings the University of Michigan Consumer Sentiment Survey, particularly important for inflation expectations.
Fed speakers? They will be interesting, I bet.
A full lineup across the hawk dove spectrum. Daly and Cook are expected to sound dovish, but New York Fed President Williams is on Thursday and will probably echo Powell's hawkish line, so you'll get both sides of the debate playing out on the schedule.
We also have some big corporate earnings.
Palantir on Monday, AMD on Tuesday, Qualcomm Wednesday. Then Uber, McDonald's, Pfizer, Saudi Aramco, ConocoPhillips, Rheinmetall, AstraZeneca. Tech earnings matter in this environment because that's where the concentration has been in the rally. If big tech disappoints, it could stress the market.
So basically, we're going to get more evidence about whether the Fed's hawkish stance is justified?
Exactly. The labor market data next week will be key. If it's strong, Powell looks right. If it's weak, he looks like he's being too hawkish too soon. That's the game.
Before we go, a reminder, we do not give investment advice. For that, please consult a professional. Selim, thanks for being here.
Thanks for having me. See you next week.
That's Economic Insights. We'll be back next week with more on markets, policy, and what it all means.